I want you to picture something that is happening right now, today, in real time, to millions of retired Americans who did everything right, who saved their whole lives, who never gambled with their money, who chose the safe path every single time a financial decision came across their kitchen table. I want you to picture a jar, a glass jar sitting on a counter. And every single morning when that retiree wakes up, walks into the kitchen, and makes their first cup of coffee, someone is standing at that counter and quietly taking money out of that jar. Not a lot at once, just a little. Every single day. While the retiree is sleeping, while they are at the doctor, while they are watching television in the evening, quietly, consistently, invisibly, the money comes out of that jar. And at the end of the year, when that retiree sits down and wonders why the balance does not feel like it grew the way it should have, why the purchasing power feels a little less than it did 12 months ago, why the comfortable cushion feels slightly thinner than it used to, the answer is sitting right there on that counter. The jar has been getting emptied a little at a time by a combination of inflation, taxation, and opportunity costs that most financial institutions in this country have absolutely no incentive to explain to you. Because the institution benefiting most from your money sitting in a low-yield savings account is the bank, not you, the bank. They are taking your deposits, lending them out at 6, 7, 8%, and paying you back somewhere between 0.4 and 4.5%, depending on which account you have and which institution you are using. And the difference between what they earn on your money and what they pay you for the privilege of using it is their profit, your loss, every single year. This is Retire Right America, and today we are going to talk about why keeping your cash in a traditional savings account in 2026 is one of the most expensive financial mistakes a retiree can make, what the 4 alternatives are that actually protect and grow your purchasing power, and what specific moves you need to make before the end of this year to stop the silent drain on your retirement security. Let me introduce you to Margaret. Margaret is 69 years old. She lives in a modest home in Scottsdale, Arizona that she owns free and clear. Her husband passed away 3 years ago. She has a traditional IRA worth about $290,000. She has Social Security of $2,100 a month, and she has $240,000 sitting in a savings account at the same national bank she has used since 1991. That $240,000 represents decades of careful saving. It represents the money she and her husband set aside during the years when the kids were grown and the mortgage was manageable and they finally had a little breathing room. It represents her emergency fund, her travel fund, her home repair fund, and the money she hopes to leave to her 2 grandchildren someday. Margaret feels safe with that money in the savings account. She can see it. She can access it any time. The FDIC insures it up to $250,000. It feels protected. It feels responsible. And it is costing her somewhere between $18,000 and $22,000 a year in lost purchasing power that she will never get back. Not in a single dramatic loss. Not in a market crash. Slowly. Quietly. Every single morning while she makes her coffee. Let me show you exactly how the math works, because this is the part that most people never actually sit down and calculate, and it is the part that changes everything when you see it clearly. Margaret's savings account at her national bank is currently paying her 1.2% annual interest. On $240,000, that is $2,880 per year in interest income. That sounds reasonable until you understand the 2 forces that are working against it simultaneously. The first force is inflation. The Federal Reserve's target inflation rate is 2% annually. The actual inflation rate experienced by retirees, which tends to run higher than the headline CPI because retirees spend a disproportionate share of their income on healthcare, housing costs, and food, has been running between 3 and 4% in recent years. At 3% inflation, the purchasing power of $240,000 shrinks by $7,200 per year. Margaret is earning $2,880 in interest. She is losing $7,200 in purchasing power. The net erosion is $4,320 per year just from the inflation gap. The second force is taxation. Margaret's interest income of $2,880 gets added to her adjusted gross income. It feeds directly into the provisional income calculation that determines how much of her Social Security gets taxed. It potentially pushes more of her Social Security benefit into the 85% taxable tier. It adds to the modified adjusted gross income figure that determines her Medicare IRMAA bracket. The $2,880 of interest income does not just get taxed at her marginal rate. It has a multiplier effect on the taxation of her other income sources. The actual after-tax value of that interest, accounting for federal income tax, the additional Social Security taxation it triggers, and the potential IRMAA exposure might be closer to $1,700. She earned $1,700 real after-tax dollars on $240,000 of savings. That is an effective real after-tax return of 0.7% on $240,000. While inflation eroded $7,200 of purchasing power, the net real after-tax loss is approximately $5,500 per year, every year, compounding, growing larger as inflation continues to work against a fixed dollar balance that is barely keeping pace with the nominal interest rate, let alone the real purchasing power loss. Over 10 years, assuming modest inflation and unchanged bank rates, Margaret's $240,000 savings account will have the purchasing power of approximately $178,000 in today's money. She will have lost the equivalent of $62,000 in real purchasing power, not because she made a bad investment, not because the market crashed, but because she kept her money exactly where her bank wanted her to keep it. Now, I need to address the objection that I know is forming in the minds of some people watching this right now. Some of you are thinking, what about high-yield savings accounts? What about the online banks paying 4.5%? And yes, if Margaret moved her $240,000 from her 1.2% national bank account to a competitive high-yield savings account paying 4 to 4.5% in 2026, her nominal interest income would jump from $2,880 to approximately $9,600 to $10,800 per year. That is meaningfully better. I am not going to tell you it is not. But I want you to understand two things about the high-yield savings account option before you conclude that it solves the problem. The first thing is that high-yield savings account rates are not fixed. They are variable. They move with the federal funds rate. When the Federal Reserve cuts rates, and rates have historically moved in cycles that can take a 4.5% high-yield account down to 1% within 2 to 3 years, your interest income drops proportionally. The family that built their retirement income plan around 4.5% high-yield savings in 2023 was earning 1.8% by late 2024 as rates adjusted. You cannot build a reliable retirement income foundation on a variable rate instrument that the Federal Reserve controls and that can cut your income in half within a single calendar year. The second thing is that even at 4.5%, the high-yield savings account still produces fully taxable ordinary income that feeds into provisional income, IRMAA calculations, and marginal bracket exposure. Every dollar of interest from that account is a dollar that potentially causes more of your Social Security to be taxed, potentially pushes you closer to the next IRMAA tier, and potentially increases your overall tax burden in ways that reduce the net after-tax benefit significantly. The high-yield savings account is better than the traditional savings account. It is not a solution to the underlying problem of keeping large amounts of cash in fully taxable, rate-sensitive instruments during retirement. So let me walk you through the 4 alternatives that actually address the problem. Not just the nominal yield problem, but the tax problem, the inflation problem, and the income stability problem simultaneously. The first alternative is Treasury securities held directly through treasurydirect.gov. United States Treasury bills, notes, and bonds purchased directly from the government at treasurydirect.gov offer several advantages over both traditional and high-yield savings accounts that most retirees have never been told about clearly. The yield on Treasury securities in 2026 is competitive with or superior to most high-yield savings accounts for comparable maturities. A 6-month Treasury bill in 2026 is yielding in the range that a competitive high-yield savings account offers. A 2-year Treasury note offers a locked rate for the full 2-year term, eliminating the rate fluctuation risk of variable savings accounts. And here is the tax advantage that is genuinely significant for retirees in states with meaningful income tax rates. Interest income from United States Treasury securities is exempt from state and local income tax. It is subject to federal income tax, but if you live in a state like California with a 13% top marginal rate, or New York, or Oregon, or Minnesota, the state tax exemption on Treasury interest is a meaningful after-tax advantage over bank savings account interest, which is fully taxable at both the federal and state level. For Margaret in Arizona, where the state income tax rate is moderate, this advantage is real, but not dramatic. For a retiree in California with $240,000 in savings, the state tax exemption on Treasury interest is worth thousands of dollars per year in avoided state income tax. Beyond the tax advantage, Treasury securities are backed by the full faith and credit of the United States government, making them as safe as FDIC insured deposits for practical purposes, with the additional benefit that there is no $250,000 coverage limit. You can hold $5 million in Treasury securities with the same government-backed safety as $50,000 in a bank savings account. The second alternative is a ladder of FDIC insured certificates of deposit, combined with Treasury securities, structured to mature at regular intervals. A CD and Treasury ladder works by dividing the savings balance into multiple tranches, each maturing at a different point in time, typically every 3, 6, 9, and 12 months, with longer-term segments extending out 2 to 5 years for the portion of the cash that does not need to be accessible in the near term. The ladder accomplishes several things simultaneously. It locks in rates at today's levels for the longer-term portions of the portfolio, protecting against rate cuts. It maintains regular liquidity as each rung of the ladder matures, and the proceeds can be spent, reinvested, or redirected as needed. It eliminates the single institution concentration risk of keeping $240,000 at one bank. And for retirees who are concerned about FDIC limits, the ladder structure allows the savings to be distributed across multiple institutions, keeping each account below the $250,000 insurance threshold. A well-structured ladder in 2026 can generate a predictable, reliable income stream from the cash portion of the retirement portfolio at rates significantly better than a standard savings account, with the inflation protection that comes from regularly reinvesting maturing tranches at current market rates rather than accepting whatever a bank passbook account offers. The third alternative is Series 1 savings bonds from the United States Treasury. Series 1 bonds are inflation-indexed savings bonds that pay a combined rate consisting of a fixed rate plus an inflation adjustment that resets every 6 months based on the Consumer Price Index. When inflation runs at 3 to 4%, I-bonds pay 3 to 4% plus the fixed component. When inflation drops, the rate drops too. But the key characteristic of I-bonds is that they are explicitly designed to preserve purchasing power against inflation, which is the primary force destroying the real value of Margaret's savings account balance. I-bonds have some important limitations. You can purchase a maximum of $10,000 per person per calendar year through treasurydirect.gov, with an additional $5,000 per year available through your federal tax refund. So the total annual purchase limit for a single individual is $15,000, or $30,000 for a married couple. I-bonds must be held for at least 12 months before redemption, and if redeemed before 5 years, you forfeit the last 3 months of interest as a penalty. But within those constraints, I-bonds are one of the most powerful inflation protection tools available to a retiree with cash savings, and they belong in the toolkit of any retirement portfolio that includes a meaningful cash component. The interest on I-bonds is also exempt from state and local income tax, providing the same state tax advantage as Treasury securities, and federal income tax on the interest can be deferred until the bond is redeemed, giving you some control over the timing of the income recognition in a way that a savings account, which reports interest annually on your 1099, does not. The fourth alternative requires a slightly different mindset, and I want to present it carefully because it involves understanding the difference between your true emergency reserve and your excess cash savings. Most financial planners recommend keeping 3 to 6 months of living expenses in immediately accessible cash. For a retiree whose living expenses run $4,000 a month, that is $12,000 to $24,000 in a savings account or money market fund, where it is truly accessible within 24 to 48 hours if needed. That is the genuine emergency reserve. Everything above that amount is not truly an emergency fund. It is excess cash savings that is being stored in an emergency fund wrapper because that is the familiar, comfortable structure that was established decades ago and never revisited. For Margaret, with $240,000 in savings and monthly expenses of approximately $3,500, her true emergency reserve is somewhere between $10,500 and $21,000. The remaining $219,000 is excess cash savings that is costing her real purchasing power every single year while sitting in a 1.2% savings account. That excess cash, the amount above the true emergency reserve, belongs in a structure that produces better after-tax, after-inflation returns. For the portion of that excess cash that Margaret knows she will not need for 3 to 5 years, a combination of Treasury securities, I-bonds, and potentially a fixed annuity or multi-year guaranteed annuity that locks in a competitive rate for a defined term can produce dramatically better outcomes than the savings account while maintaining a level of safety and predictability that is appropriate for a retiree who is not interested in equity market risk. I want to be clear about what I am not saying, because nuance matters, and Retire Right America has always been about giving you accurate, complete information, rather than oversimplified, fear-driven advice. I am not telling you to put your emergency fund in the stock market. I am not telling you to chase yield with money you cannot afford to lose. I am not telling you that safety and liquidity are unimportant. The 3 to 6 month emergency reserve and FDIC insured savings, or a money market account, is the right structure for that specific portion of your cash. What I am telling you is that keeping a $240,000 balance in a savings account because you opened that account in 1991 and it feels safe and familiar is not a financial strategy. It is a habit. And that habit, in 2026, with the inflation and tax dynamics that currently exist, is costing retirees like Margaret thousands of dollars per year in lost purchasing power that compounds silently and permanently into a significantly smaller retirement nest egg 10 and 20 years from now. Go to the comment section right now and tell me how much you currently have sitting in a traditional savings account or a CD at a bank, and tell me what interest rate that account is currently paying you. Tell me your state so I can factor in the state tax dimension. Because what I hear constantly in the comments here at Retire Right America is that people have no idea what their savings account is actually paying, have not looked at the rate in years, and have never sat down and calculated the real after-tax, after-inflation return on money they have been storing in the same account since before the internet existed. Drop your number in the comments. We work through the math together. Like this video if the glass jar metaphor hit differently than you expected. Subscribe to Retire Right America and hit the notification bell because every video on this channel is a different piece of the retirement income puzzle that the financial industry profits from keeping complicated. Share this with someone you know who has a large savings account balance and has not questioned whether it is working for them, because the silent drain on their purchasing power is running right now, whether they know about it or not. The jar is on the counter. The money is coming out. The only question is whether they find out in time to do something about it. This is Retire Right America. Stay informed, stay protected, and do not let comfort cost you what you cannot afford to lose.